An example of NZX's dairy ingredient futures. This example is of a drink manufacturing company. Steve is a procurement manager who was using whole milk powder futures to hedge his company's whole milk powder price risk. Because Steve buys whole milk powder as an ingredient in his company's production of drink products, he would naturally buy whole milk powder futures in order to protect from the risk of rising prices, which is known as a long futures position. Steve buys 10,000 metric tons of regular grade whole milk powder per year. His budgeted price for the next year is $3,000 per metric ton, and he is wanting to secure a price below his budget on a portion of his forecast quantity for the year ahead. At the start of the year, Steve checks the whole milk powder futures market via his broker, which shows that traders in the market are willing to sell 1,000 metric tons of whole milk powder futures at $2,800 for March settlement. One lot of whole milk powder futures equates to 1 metric ton of whole milk powder. Steve decides to secure prices $200 better than his procurement budget and remove the risk of future price moves against him. Steve buys 1,000 lots of whole milk powder futures at a price of $2,800, or 10% of his annual forecast procurement. To enter the position, Steve needs to fund his margin account. At the time, initial margin rates are $200 per lot. For 1,000 lots, Steve needs to post $200,000 to pre-fund his margin account with his broker to open the hedge. Initial margin acts like a bond and is repaid when the futures position settles or is closed. Steve funds his margin account and opens a futures position buying 1,000 lots of whole milk powder futures at $2,800. Between now and the settlement date of the futures contract, if there are changes in the price of the futures market, variation margin must be paid or received. This is quite straightforward. For a buyer, it is simply the daily settlement price, which is the price where market trading finished on the day, minus the price of Steve's futures position. The next day, the futures market price rises to $3,000. Steve receives $200,000 variation margin into his brokerage account. On the second day, the daily settlement price moves lower to $2,600. Steve now has to ensure that $400,000 is available in his margin account to cover the $400 move lower. He uses the $200,000 received yesterday and adds $200,000 more to cover the additional $200 market movement. Variation margin can change throughout the life of the contract as the market price moves, which is why Steve has a margin finance facility in place with his company's bank, with sufficient headroom to allow for moves lower in price. It is now March, and Steve needs to procure his whole milk powder, for which prices have recently been trading higher than $3,000. Steve logs on to the first global dairy trade event for March and buys 500 metric tonne of regular New Zealand grade whole milk powder in the contract to delivery period at $3,100. At the second GDT event in March, Steve then bids for a further 500 metric tonnes of regular New Zealand grade whole milk powder in the contract to delivery period, and the price finishes higher again at $3,300. Steve has procured his 1,000 metric tonnes of whole milk powder. Steve has purchased whole milk powder from GDT at an average price of $3,200 for 1,000 metric tonnes. However, Steve still has his futures contract, which secured his price at $2,800. The final settlement price of Steve's whole milk powder futures contract is the simple average of the regular New Zealand grade contract 2 prices from the 2 GDT events in the month of March. Steve then receives a gain of $400 per metric tonne from the settlement of his futures contracts. This is the difference between his bought futures at $2,800 and the final settlement price of $3,200. When added to his effective purchase price, it nets out to $2,800. If the average price for regular New Zealand grade contract 2 whole milk powder at the 2 GDT auctions in March had been $2,400, then Steve would have paid $2,400 per metric tonne to purchase his physical whole milk powder and had to pay an additional $400 per metric tonne on the settlement of his whole milk powder futures position, again giving him an effective rate of $2,800. In this way, whole milk powder futures have allowed Steve to lock in the future price of $2,800 for 1,000 metric tonne, or 10% of his annual requirement of whole milk powder, despite any movements in the underlying physical market. Steve's initial margin is also returned to him by his broker upon settlement of the contract. However, if Steve purchased different quantities at different times on GDT, he may have paid a different end price for his whole milk powder than the NZX settlement price, which is the simple average of regular New Zealand grade Contract 2 prices from the two GDT events. This difference is called basis. Hedgers are still able to use NZX futures to manage their price risk, but it is important to understand the implications of this risk. For further explanations and examples of basis risk or to learn more, please refer to our other educational videos at the link on screen.